Imagine you're standing at the edge of a bustling stock market, surrounded by screens flashing with numbers and news headlines that seem to scream, "Invest now." It's tempting to jump in, isn't it? But before you take the plunge, ask yourself, are you an investor or a speculator? Do you have a solid strategy, or are you just winging it? 75 years ago, a man named Benjamin Graham asked himself those very same questions. Graham, a young investor at the time, got burned in the 1929 stock market crash. But instead of giving up, he used that experience to develop a set of principles that would become the foundation of his investing philosophy. And in 1949, he shared those principles with the world in his book, The Intelligent Investor. Today, we're going to explore why Graham's ideas remain essential for anyone looking to build long-term wealth. You'll learn how his disciplined approach can help you avoid common pitfalls and make informed decisions even in the face of market turmoil. And with the added insights of Jason Zweig's commentary, you'll see how Graham's principles have been applied by some of the most successful investors in history, including Warren Buffett, who credits Graham as his mentor. As we dive into the world of intelligent investing, you'll discover the difference between a speculative gamble and a smart, long-term investment strategy. You'll learn how to think like a business owner, not just a stock trader. And you'll gain the confidence to make decisions that will serve you well no matter what the market throws your way. So, what does it mean to be an intelligent investor? Let's start by looking at the story of Benjamin Graham himself and the lessons he learned from his early days as a young investor. Section 1. Imagine you're at a dinner party and someone asks, "What's the secret to investing like a pro?" You might expect a complicated answer, but the truth is surprisingly simple. It all comes down to having the right mindset. In The Intelligent Investor, Benjamin Graham emphasizes that successful investing is not just about the stocks you pick or the strategy you use, but about how you think and behave. Let's take Charlie Munger, Warren Buffett's business partner, as an example. Munger is a billionaire investor known for his discipline and patience. He once said, "All I want to do is get richer by owning good businesses." Sounds easy, right? But what's remarkable about Munger is his ability to stick to his principles. Even when the market is volatile or everyone around him is panicking. He's like the investment version of a Zen master, calm, focused, and unflappable. So, what sets Munger and other successful investors apart? Graham would say it's their ability to distinguish between investing and speculating. Investing is about putting your money into a business or asset that has a high chance of generating returns over the long term. Speculating, on the other hand, is like betting on a horse race. It's a gamble and you might win big, but you're just as likely to lose everything. The problem is our emotions often get in the way of making smart investment decisions. We get caught up in the excitement of a hot new stock or the fear of missing out on a trend. Graham calls this the speculative element, the tendency to prioritize short-term gains over long-term stability. It's like trying to time the market, which is a recipe for disaster. As Graham says, the investor's chief problem and even his worst enemy is likely to be himself. So, how do you develop the investor's mindset? It starts with adopting a long-term perspective. Graham recommends thinking of investing as a marathon, not a sprint. Instead of trying to make quick profits, focus on building wealth over the next 5, 10, or 20 years. This means being patient and disciplined even when the market is turbulent. A great example of this approach is the Vanguard 500 Index Fund. Since its inception in 1976, the fund has returned an average of around 10% per year, outperforming many actively managed funds. The secret to its success? A disciplined investment strategy that focuses on the long game rather than trying to time the market or pick individual winners. Graham would say that this kind of approach requires a clear investment philosophy, a set of principles that guide your decisions and help you stay on track. It's like having a compass that keeps you oriented even when the market is spinning around you. Without a clear philosophy, you're like a ship without a rudder, drifting aimlessly on the tides of speculation. In the next part of our journey, we'll explore how to develop your own investment philosophy using Graham's timeless principles as a guide. But for now, remember that the investor's mindset is all about discipline, patience, and a long-term perspective. It's not about being a genius or having a magic formula. It's about being clear-headed, calm, and committed to your goals. As Graham says, the intelligent investor is a realist who sells to optimists and buys from pessimists. So, let's cultivate the kind of mindset and see where it takes us. Section 2. Imagine you're at a casino surrounded by the sound of clinking glasses and the hum of excitement. You're about to play a game, but it's not roulette or blackjack, it's the stock market. You're not sure what the next card will be or which way the wheel will spin. All you know is that you want to win. But how do you make informed decisions when the outcome is far from certain? This is the world of investing, where probability reigns supreme. Benjamin Graham, the father of value investing, understood this concept all too well. In his timeless classic, The Intelligent Investor, Graham reminds us that investing is a game of probability, not certainty. And to succeed, we need to think like a probability expert, not a fortune teller. Let's start with the concept of Mr. Market, Graham's famous metaphor for the stock market. Imagine Mr. Market as a moody business partner who offers you a different price for your shares every day. Sometimes he's optimistic and wants to buy from you at a high price. Other times he's pessimistic and wants to sell to you at a low price. Your job is to take advantage of Mr. Market's mood swings, buying when he's feeling down and selling when he's feeling up. But how do you know when to buy or sell? This is where the margin of safety comes in, a concept that's central to Graham's investing philosophy. Think of the margin of safety like a buffer zone between the price you pay for a stock and its true value. The wider the buffer, the less risk you take on. Graham's idea is to buy companies with a wide margin of safety, so even if things don't go as planned, you'll still have a cushion to fall back on. Now let's talk about diversification, the art of spreading your bets across different asset classes, sectors, and geographies. Diversification is like playing multiple games at the casino simultaneously. You're not putting all your chips on one table, so if one game doesn't go your way, you've got others to fall back on. Graham emphasizes the importance of diversification in managing risk. By spreading your investments, you reduce your reliance on any one stock or sector, making it easier to ride out market fluctuations. But how do these principles play out in real life? Let's look at the 2008 financial crisis, a time when the markets were in chaos. Investors who applied Graham's principles were able to navigate the turmoil with relative ease. They had a margin of safety, having bought companies with strong fundamentals at low prices. They were diversified, having spread their investments across different asset classes. And they were patient, knowing that the market would eventually recover. One investor who exemplified these principles is Warren Buffett, a disciple of Graham's. During the 2008 crisis, Buffett was buying while others were selling. He invested in companies like Goldman Sachs and General Electric, taking advantage of their low prices and strong fundamentals. Buffett's margin of safety and diversification helped him weather the storm, and his investments ultimately paid off. So, how can you apply probability thinking to your investment decisions? One useful tool is the Kelly criterion, a formula for determining the optimal size of a bet based on the probability of winning. The Kelly criterion helps you balance risk and reward, ensuring that you're not betting too much or too little. For example, if you think a stock has a 60% chance of going up and a 40% chance of going down, the Kelly criterion would tell you to allocate 20% of your portfolio to that stock. In conclusion, investing is a game of probability, not certainty. By understanding the concept of Mr. Market, the importance of margin of safety, and the role of diversification, you can manage risk and increase your chances of success. By applying probability thinking to your investment decisions, you can make more informed choices and avoid costly mistakes. And by learning from the experiences of investors like Warren Buffett, you can develop the skills and confidence to navigate even the most turbulent markets. As Graham reminds us, price is what you pay. Value is what you get. By focusing on value, not price, you can make more informed decisions and achieve your long-term goals. In the next chapter, we'll explore how to apply these principles in practice, from selecting individual stocks to constructing a diversified portfolio. But for now, let's leave with a key takeaway. Investing is a game of probability, and by understanding the rules, you can increase your chances of winning. Section 3. Imagine you're on a treasure hunt, searching for a chest overflowing with golden coins. But instead of a map, you have a set of principles to guide you through the jungle of the stock market. That's what Benjamin Graham's approach to stock selection is all about: finding the hidden gems, the undervalued companies with strong potential for growth. And who better to illustrate this than Warren Buffett, one of Graham's most famous disciples? You see, Warren Buffett's investment in Coca-Cola back in the late 1980s is a fantastic example of Graham's principles in action. At the time, the stock market was going through a period of high volatility and many investors were running for cover. But not Buffett. He took a closer look at Coca-Cola's financial statements and saw something that many others missed: a company with a strong brand, a solid balance sheet, and a proven track record of generating cash. He applied Graham's principles and his investment paid off handsomely. Today, Coca-Cola is one of the most recognizable brands worldwide, and Buffett's investment has returned many times over. So, what exactly did Buffett see in Coca-Cola that others didn't? He saw a company with a high intrinsic value, a concept that's at the heart of Graham's investment philosophy. Intrinsic value is the true worth of a company based on its underlying financials, management quality, and competitive position. It's the present value of all the cash that can be taken out of a business during its remaining life. And according to Graham, it's the key to successful stock selection. But how do you estimate a company's intrinsic value? That's where financial statement analysis comes in, the process of examining a company's income statements, balance sheets, and cash flow statements to get a sense of its financial health. Graham was a master of financial statement analysis, and he developed a set of criteria to help investors identify undervalued companies. He looked for companies with strong financial positions, competitive advantages, and talented management teams. One of the tools that Graham used to estimate intrinsic value was the Graham number. It's a simple yet powerful formula that calculates a stock's intrinsic value based on its earnings per share and book value per share. The idea is to compare the Graham number to the stock's current price and see if there's a significant gap between the two. If the stock price is lower than the Graham number, it may indicate that the company is undervalued and has potential for growth. For example, let's say you're looking at a company with earnings per share of $5 and book value per share of $50. Using the Graham number formula, you calculate the intrinsic value to be around $75 per share. But the current stock price is only $50 per share. That's a significant gap, indicating that the company may be undervalued. Of course, this is just one tool among many, and investors should always do their own research and analysis before making a decision. Graham's approach to stock selection is not just about numbers, though. He also emphasized the importance of qualitative factors such as management quality and competitive position. A company with a strong management team and a competitive advantage is more likely to succeed in the long run, even if its financials are not perfect. As Jason Zweig notes in his commentary, Graham's approach to stock selection is not a magic formula but rather a disciplined process of analysis and decision-making. It requires patience, persistence, and a willingness to go against the crowd. But for those who are willing to put in the work, the rewards can be significant. So, what can we learn from Graham's approach to stock selection? First and foremost, it's the importance of fundamental analysis, examining a company's underlying financials and competitive position to estimate its intrinsic value. It's also the need to be patient and disciplined in our investment decisions rather than chasing after hot stocks or trying to time the market. And finally, it's the value of qualitative factors such as management quality and competitive position in identifying companies with strong potential for growth. As we continue on this journey through the world of value investing, we'll explore more of Graham's principles and strategies for successful stock selection. But for now, let's take a page from Warren Buffett's playbook and remember that the art of stock selection is not just about finding the next big thing, but about identifying undervalued companies with strong potential for growth. And with Graham's principles as our guide, we'll be well on our way to becoming intelligent investors. Section 4. Imagine you're on a road trip and you've got your GPS set to take you to your dream destination. But instead of just following the directions, you're constantly checking the map, looking for shortcuts, and adjusting your route to avoid traffic jams. That's basically what portfolio management is all about. It's the process of creating a roadmap for your investments, regularly checking in to make sure you're on track and making adjustments as needed to reach your financial goals. Now, you might be thinking, but I'm not a professional investor. I don't have the time or expertise to manage my portfolio like a pro. Well, the good news is that you don't need to be a pro to be a successful investor. What you do need is a clear understanding of the principles of portfolio management, and that's exactly what we're going to explore in this section. Benjamin Graham, the father of value investing, was a big advocate for portfolio management. In The Intelligent Investor, he writes, "The art of portfolio management is a balancing act between the desire for high returns and the need for safety." Graham's principles of portfolio management are just as relevant today as they were when he first wrote them, and we're going to examine how they can help you develop a clear strategy for managing your investments. So, let's start with the foundation of portfolio management, asset allocation. Asset allocation is the process of dividing your investments among different asset classes, such as stocks, bonds, and real estate. It's like creating a recipe for your investments where you're combining different ingredients in the right proportions to achieve your desired outcome. Graham was a big believer in the importance of asset allocation, and he recommended that investors allocate their assets based on their individual financial goals and risk tolerance. Now, you might be thinking, but how do I know what the right asset allocation is for me? Well, that's a great question. The answer is that it depends on your individual circumstances. For example, if you're young and just starting out, you may want to allocate a larger portion of your portfolio to stocks, which have historically provided higher returns over the long term. On the other hand, if you're closer to retirement, you may want to allocate more of your portfolio to bonds, which are generally less volatile and provide more income. Another key principle of portfolio management is diversification. Diversification is the process of spreading your investments across different asset classes and industries to reduce your risk. It's like the old saying goes, don't put all your eggs in one basket. By diversifying your portfolio, you can reduce your exposure to any one particular investment or industry and increase your potential for long-term returns. Graham was a big believer in the importance of diversification, and he recommended that investors diversify their portfolios across different asset classes and industries. For example, if you're investing in stocks, you might want to diversify your portfolio by investing in a mix of large-cap, mid-cap, and small-cap stocks, as well as stocks from different industries such as technology, healthcare, and finance. Now, let's talk about risk management. Risk management is the process of identifying and mitigating potential risks in your portfolio. It's like having a fire extinguisher in your kitchen. You hope you never need it, but it's there just in case. Graham was a big believer in the importance of risk management, and he recommended that investors regularly review their portfolios to identify potential risks and take steps to mitigate them. One way to manage risk is to use a technique called portfolio rebalancing. Portfolio rebalancing is the process of regularly reviewing your portfolio and making adjustments to ensure that it remains aligned with your target asset allocation. For example, if you've allocated 60% of your portfolio to stocks and 40% to bonds, but the stock market has been doing well and your portfolio is now 70% stocks and 30% bonds, you might want to rebalance your portfolio by selling some of your stocks and buying more bonds. So, how can you apply these principles of portfolio management to your own investments? One approach is to use a core satellite strategy. A core satellite strategy involves dividing your portfolio into two parts: a core portfolio that provides broad diversification and a satellite portfolio that allows you to take on more risk and potentially earn higher returns. For example, you might allocate 80% of your portfolio to a core portfolio of index funds or ETFs that track the overall market, and 20% to a satellite portfolio of individual stocks or actively managed funds that you believe have the potential to outperform the market. This approach allows you to balance your desire for high returns with your need for safety and diversification. Now, let's talk about an investor who exemplifies effective portfolio management, Ray Dalio. Ray Dalio is the founder of Bridgewater Associates, one of the largest hedge funds in the world. Dalio is known for his unique approach to portfolio management, which involves using a combination of quantitative models and qualitative analysis to make investment decisions. Dalio's approach to portfolio management is centered around the idea of radical transparency. He believes that investors should be completely transparent about their investment process and decision-making, and that they should be willing to challenge their own assumptions and biases. Dalio's approach has been incredibly successful, and Bridgewater Associates has delivered returns that are significantly higher than the overall market over the long term. So, what can we learn from Ray Dalio's approach to portfolio management? One key takeaway is the importance of having a clear investment process and sticking to it. Dalio's approach is highly disciplined and systematic, and he is not afraid to challenge his own assumptions and biases. Another key takeaway is the importance of radical transparency. By being completely transparent about his investment process and decision-making, Dalio is able to build trust with his investors and make more informed investment decisions. In conclusion, portfolio management is a critical component of successful investing. By understanding the principles of asset allocation, diversification, and risk management, you can develop a clear strategy for managing your investments and achieving your financial goals. Whether you're a seasoned investor or just starting out, the principles of portfolio management can help you navigate the ups and downs of the market and achieve long-term success. Section 5. Here's the script for this section of the audiobook. Imagine you're driving on a winding road and suddenly a car cuts you off. Your heart rate spikes and you feel a surge of anger. But then you take a deep breath, calm down, and continue driving safely. Now imagine that same emotional response happening when you're making investment decisions. A sudden market downturn, a stock's unexpected drop, or a friend's hot tip can trigger emotions that cloud your judgment. This is where behavioral finance comes in, the study of how our emotions, biases, and mental shortcuts affect our investment choices. Benjamin Graham, the father of value investing, understood the importance of emotional control in investing. In The Intelligent Investor, he wrote, "The investor's chief problem and even his worst enemy is likely to be himself." Graham recognized that investors' emotions and biases can lead to costly mistakes. So, how can we overcome these pitfalls and develop a more disciplined investment approach? Let's take the story of Daniel Kahneman, a Nobel Prize-winning economist who's also an expert in behavioral finance. Kahneman, in his book Thinking Fast and Slow, describes how our brains use mental shortcuts or heuristics to make quick decisions. These shortcuts can lead to systematic errors in thinking, which can be disastrous in investing. However, Kahneman also shows that by becoming aware of these biases, we can learn to overcome them. As an investor, Kahneman has said that he's learned to slow down and take a more deliberate approach to decision-making, rather than relying on his initial intuition. One of the most common biases that investors face is confirmation bias. This is the tendency to seek out information that confirms our existing opinions, rather than seeking out diverse perspectives. For example, imagine you've invested in a particular stock, and you start reading news articles and analyst reports that confirm your decision. You might feel good about your investment, but you're not getting a complete picture. Graham's principles can help us overcome confirmation bias by encouraging us to seek out diverse perspectives and question our assumptions. So, how can we apply Graham's principles to overcome common behavioral pitfalls? One useful tool is a decision-making checklist. Before making an investment decision, take a step back and ask yourself a series of questions. What are the company's financials? What's the competitive landscape? What are the potential risks and downsides? By using a checklist, you can slow down your decision-making process and ensure that you're considering all the relevant factors. Another key principle is self-awareness. Understanding your own emotions, biases, and risk tolerance is essential for making informed investment decisions. Graham wrote, "It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. By acknowledging our own limitations and biases, we can take steps to overcome them. For instance, if you know that you're prone to emotional decision-making, you might consider implementing a cooling-off period before making investment decisions. This could be as simple as waiting 24 hours before buying or selling a stock. By taking a step back and calming down, you can make more rational decisions that align with your long-term goals." In conclusion, behavioral finance is a crucial aspect of investing that can help us understand our own emotions, biases, and mental shortcuts. By recognizing these pitfalls and applying Graham's principles, we can develop a more disciplined investment approach that leads to long-term success. As Graham wrote, "The intelligent investor is a realist who sells to optimists and buys from pessimists." By being aware of our own biases and emotions, we can become more intelligent investors and achieve our financial goals. This script should flow logically and connect the key points, stories, and examples into a continuous narrative. I've maintained a conversational tone and referenced the book The Intelligent Investor where relevant to ground the discussion. I've also woven in stories, metaphors, and analogies naturally while breaking down complex ideas into simple, understandable explanations. Let me know if you need any further changes. Section 6. Imagine you're standing at the edge of a serene lake on a crisp autumn morning. The mist is gently lifting, revealing the vibrant hues of the changing leaves. It's a moment of perfect tranquility, a reminder that some principles in life remain timeless, untouched by the whirlwind of change. For investors, Benjamin Graham's principles, as outlined in The Intelligent Investor, are like that serene lake, offering a steady foundation amidst the turbulence of the modern investment landscape. 75 years have passed since Graham first shared his wisdom with the world. In that time, the investment world has undergone seismic shifts. The rise of the internet and digital technologies has transformed how we invest, making it easier and faster than ever before. Yet, despite these changes, Graham's principles remain as relevant today as they were when he first penned them. The question is, how can we apply these timeless principles in the modern era? Let's consider the story of Seth Klarman, a highly successful investor known for his value investing approach deeply rooted in Graham's principles. Klarman's story is a testament to the adaptability and enduring relevance of Graham's teachings. In a world where technology and trends can quickly sway investment decisions, Klarman has remained steadfast, focusing on the intrinsic value of companies and adhering to a disciplined investment strategy. His success is a powerful reminder that Graham's principles are not relics of the past but robust frameworks for navigating the complexities of the 21st century. One of the key challenges investors face today is the temptation to get caught up in the whirlwind of short-term market fluctuations. With technology at our fingertips, it's easier than ever to get sucked into the vortex of daily market news, making impulsive decisions based on short-term market movements. Graham's principles, however, urge us to resist this temptation, to stay focused on our long-term goals, and to cultivate a discipline that allows us to ride out the inevitable storms of the market. So, how can we apply Graham's principles in a practical way to navigate the modern investment landscape? One effective strategy is tax loss harvesting, a technique that involves selling securities that have declined in value to offset gains from other investments. This approach not only helps in managing taxes but also encourages investors to regularly review their portfolios, ensuring they remain aligned with their long-term investment objectives. It's a prime example of how Graham's principles can be adapted and applied in a contemporary context to enhance investment outcomes. Another critical aspect of investing in the modern era is understanding the role of technology in investment decisions. While technology has opened up a world of information and opportunities, it also presents challenges such as information overload and the potential for making impulsive decisions based on short-term market movements. Graham's principles remind us of the importance of a disciplined approach, one that is grounded in thorough research and a clear understanding of the companies in which we invest. The rise of passive investing is another significant trend in the modern investment landscape. While passive investing offers a low-cost way to gain exposure to the market, it's essential to remember Graham's emphasis on the importance of a thoughtful, active approach to investing. This doesn't mean that investors should eschew passive investing entirely, but rather that they should approach it with a critical and discerning eye, ensuring that it aligns with their overall investment strategy and goals. In the end, investing in the modern era with its rapid pace and technological advancements requires a blend of timeless principles and adaptability. Graham's teachings offer us a foundation upon which we can build, a reminder that, despite the many changes in the investment landscape, the core principles of successful investing remain unchanged. As we navigate the complexities of the 21st century, Graham's principles serve as a beacon, guiding us towards a disciplined, long-term approach that is as relevant today as it was 75 years ago. And so, as we stand at the edge of that serene lake, we're reminded that, in the world of investing, some principles endure, untouched by time. They offer us a steady foundation, a guiding light that helps us navigate the challenges of the modern era, ever focused on our long-term goals and ever adaptable in the face of change. Conclusion: as we wrap up our journey through The Intelligent Investor, I want to leave you with a sense of the profound impact Benjamin Graham's work has had on the investment community. His principles, though penned 75 years ago, remain the gold standard for investors seeking long-term success. So, what are the key takeaways from this timeless classic? For me, it all boils down to discipline, patience, and a long-term perspective. Graham's investment philosophy is not about getting rich quick or trying to time the market. It's about cultivating a deep understanding of the companies you invest in and having the conviction to stick with them through thick and thin. It's about being a business owner, not a stock trader. I love the story of how Warren Buffett, one of Graham's most famous disciples, applied these principles to build Berkshire Hathaway into the behemoth it is today. Buffett's track record is a testament to the power of Graham's ideas, and it's a reminder that, with the right mindset and strategy, anyone can achieve remarkable results. As I reflect on Graham's legacy, I'm reminded of a beautiful metaphor he used to describe the stock market: a moody business partner. Imagine you own a small business with a partner who's prone to wild mood swings. One day, they're ecstatic about the future, the next, they're despondent. If you let their emotions dictate your decisions, you'll make reckless choices that can harm your business. But if you stay calm, focus on the fundamentals, and take a long-term view, you'll make better decisions and build a more prosperous future. So, as you close this book and embark on your own investment journey, I want to leave you with a challenge. Will you be a short-term speculator, chasing fleeting gains and courting unnecessary risk? Or will you be a long-term investor, guided by discipline, patience, and a deep understanding of the businesses you own? The choice is yours, but I hope Graham's wisdom has inspired you to take the road less traveled, the road to long-term wealth and financial freedom. In the end, The Intelligent Investor is more than just a book about investing, it's a guide to living a more intentional, more patient, and more prosperous life. May its timeless principles guide you on your own journey to financial independence, and may you always remember the enduring legacy of Benjamin Graham, the father of value investing.